guys, welcome back to another True Story debate. This time I'm super stoked to have two really awesome people debate whether markets are braced for a global downturn. And we have Thomas Lee from Fundstrat and Paranoid Bull on Twitter. And I'll let them start off with a 30-second intro and we'll honestly just jump right in. Go for it, Thomas.
Thank you. Yeah, you sure you want me to start?
Yeah, that's fine.
30-second intro.
Oh, sorry. Yes, I'm Tom Lee. I'm the co-founder of Fundstrat Global Advisors, and we're an independent research firm. I think we're just best known for evidence-based research.
And I'm David Levine. I'm the founder of Odin River. It's a mission-driven investment firm, but I am also very active on Twitter under Paranoid Bull, which is a blog I actually started prior to the last cycle in 2007. So really enjoy being here and being in this conversation and would love to contribute to the True Story community.
Awesome. Well, okay, so both of you disagree to the fact that whether the markets are braced for a global downturn. And we had this debate on True Story, and even on True Story it was actually very evenly contested. There was a lot of challengers, there's a lot of backers. So I'm going to start with Paranoid Bull, and you fundamentally are very bearish on the market.
Mm-hmm.
So can you explain why?
Yeah, sure. So my way of thinking is actually quite simple. I think that there's two primary facts that exist in the markets. One is that progress is inevitable. So I'm actually massively optimistic in the long run. In fact, I'm so optimistic though that the old system needs to collapse. So I actually think cycles matter, and I think the old system's in the process of collapsing for various reasons. The number one most important reason is that sovereign credit, meaning government debt, has been mispriced for a decade. That forced the prices of everything to be mispriced, led to a bigger credit bubble than we had last cycle. And like every cycle in the past, there's also a very important fundamental driver to prices, which is the business cycle. And the business cycle is at the tail end of the longest expansion in history. It's slowing down in China, Germany's in a recession, the US is also rolling over. So between mispricing and sovereign credit across asset classes, the biggest credit bubble in history, and now having slowing fundamentals, it makes me believe that not only is the system due for a failure, or generally, but also the cycles matter and markets are going to decline globally. And I can talk about this in various different ways, but that's kind of the general framework that I used to think about it. And I think it's actually already begun. I think it began last year.
Brilliant, awesome.
Thank you.
All right, Thomas, so can you share what your bear case is and why you're so bearish on the market?
Oh,
Bullish.
Well, now I'm a bear now.
Sorry.
I'm generally constructive on U.S. stocks. I agree with David. In fact, David and I know each other well. I agree with the majority of his points. I think that there is something really deeply troubling about the level of interest rates in the world. The fact that a trade war has now caused essentially a complete standstill in the economies of Europe and lots of Asia. And I think I'm equally disturbed by the fact that the markets have become so reliant on central banks really to sort of rescue and provide liquidity. But despite what appear to be overwhelmingly negative arguments, I'm actually very bullish on US stocks. And it comes down to a couple simple things. First of all, I think it's really sort of an evidence-based observation. I think that these are all things that really should be taking down the S&P, and especially in August had every reason to. But instead what we've seen is an equity market that's hovering near its all-time highs. And it's not because a few stocks are holding up the market. We are seeing the advanced decline for not only New York Stock Exchange, but the S&P hit all-time highs. This is a massive, massive supported market with every single stock participating. That's really bullish. But more importantly, I think that one of the things I've observed since '09 has been a bubble of pessimism. I came from JP Morgan where I was the chief equity strategist, and I think our clients and the bank itself was concerned for the first 5 years that we were going to have a double-dip recession. And now that we're 10 years into this expansion, I think markets are understandably paranoid that another downturn's around the corner, but I think a lot of economic evidence points to the US being mid-cycle. And if we're mid-cycle and markets are hovering near all-time highs, to me this smells like a breakout.
What do you think about that?
So we look at the S&P 500, it has been relatively flat. So I agree with Thomas that, especially in August, it's been resilient. However, at the levels today, which is right around 3,000, 2990 or something like that, it's about 2.4% higher than it was the same day last year, which to me means the markets are actually flat. Now that's in the backdrop of a background where the ECB has reached their limits. The ECB now has announced, I think, the end of what they can do from an easing perspective, in that both Germany and the Dutch have said that the ECB has basically crossed the limit of what they can do. The Fed has pivoted from quantitative tightening to, I think, arguably quantitative easing with what they've done in the recent weeks to stave off the repo market, which is repo market failing, which has actually caused the balance sheet to expand. And the Fed has eased. So the Fed has reversed course, cut rates. ECB is out of bullets. China has also eased, I left that out, and markets are basically flat. So to me, that's not bullish for stocks. It actually just shows that there's really no place to hide. I do think that people are hiding in US equities, thinking that maybe the dividend yield is supported, or maybe that on some kind of relative basis, the US is actually growing more than the rest of the world. So I think there's reasons why people are hiding in US stocks, but I actually think fundamentals are worse. And even with all these central bank actions, all they can do is keep the markets flat. And so therefore, actually, I think there's more downside today, especially if we add to the equation that you have industries like semiconductors, where South Korea had exports down 40%. You have, like I said, Germany in a recession. China, even the president of China, now saying they can't grow at their target of 6%. So fundamentals are actually starting to roll over. In this Q3, we're going to have an earnings recession in the S&P 500, which again I think is late cycle. So I don't believe that the U.S. is in a recession. I don't know if they are or aren't, so I understand why on a relative basis people may want to kind of hide U.S. equities. I think they are, but I don't think that's enough to keep the market stable where they are today.
Yeah, and again, I don't think it's the same thing David said I disagree with. But I think it's an like I would make a counterpoint observation, which is, stocks have gone nowhere, actually for 20 months. And so in the last 12 months, they're like flat. In the last 20 months, they're actually flat. And I hear that as a statistic cited by the bears, like, hey, listen, all this stuff's happening and the markets are flat. What's interesting is if you go back to 1900 and you say, okay, how many times has the equity market been flat for 20 months and for 12 months within 1% of its highs? It's only happened 3 times, 51 to 53, sorry, I don't remember the other dates, but it's happened 3 times, so we'll edit that. Yeah. 3 of 3 times, the resolution was a massive upside breakout in stocks. The average gain's 51%, with the range being anywhere from 30 to 71%. So to me, nowhere markets where, especially today, I think consensus is quite bearish on stocks. I think the majority of our clients are clearly bearish. I have friends who text me about, Tom, when's the next recession happening, because they saw on Good Morning America a segment about the inverted yield curve. I think the world today is pricing in, or attempting to price in, a recession that may or may not happen. But if it doesn't happen, then I think an upside breakout is what we're going to see.
Let me kind of digest the point and then reply. So I think that comparing our current environment to history is really difficult. The reason is that we're in a truly unprecedented market. And especially, if you look at over the last, since 1980 through 2008, what's happened every 7 to 10 years is we've had pronounced credit cycles, which then caused equity markets to decline. They typically coincide with one another. The reason for that is that since the 80s, starting with the savings and loan crisis, real estate, the telecom boom and bust, and then obviously people know about the subprime mortgage crisis. The telecom boom and bust actually coincided with the dot-com bubble, which I think we have similar signs of excess in the private unicorn market today as we did in the dot-com bubble. Each of those were precipitated by credit bubbles. And so unlike the times that Thomas mentioned in the past where equity markets were kind of settling near highs, today we have the largest credit bubble in history. And so the mispricing that's occurred in sovereign credit and therefore corporate credit, where you have literally $1 trillion of negatively yielding corporate bonds, which should never exist, meaning you have companies that are being paid to borrow, not governments, companies being paid to borrow. To me, that level of distortion is far greater than what we had in the subprime crisis. In the subprime crisis, we had about a $12 trillion market, which was the housing market. And in that, the rates were a little bit low for various reasons, and it was securitized. Now we have 40 to 50 trillion of sovereign credit. We have the entire corporate credit complex, in my opinion, including $1 trillion of negatively yielding credit. You have a CLO market of over $1 trillion. And so this credit bubble that is kind of out there waiting, and in the beginning, in my opinion, of starting to show some signs of weakness, given some of the fundamentals. We saw Thomas Cook file for bankruptcy today. And so, if the credit bubble, which I think should, kind of deflate, which is how these things go, as that starts to deflate, that will be the real cause for equity markets to decline. And so I actually think it's just different than it was in the past, given that backdrop. And I don't believe that because central banks are at the limits of their policy and cycles matter, meaning fundamentals actually are rolling over, I don't believe that they can keep the credit issues contained. And so what I actually think is going to happen is we're going to have more credit volatility, which we've kind of seen a little bit of. We had a blow off top in August. You had the Austrian 50-year up 50%. You had things like the German Bund up 20%, and then you had a sell-off right before some of this recent oil market volatility. And so I think the credit market volatility is the key thing to watch. As that unfolds, that'll be the main driver of equity market weakness. So that, I mainly just disagree about kind of the background today versus maybe what it was like in the past whenever equity markets high.
I would say it's true. With technology, population demographics, even sort of global trade, it's hard to say things in the past should replicate itself today or should be relevant. But there's a lot of striking parallels. I think one example, for instance, is the 40s and 50s was really characterized by extremely low inflation. In fact, the 10-year was lower in that period of time than any modern day print of the US 10-year. So the low print we saw in 2016, I think of the 127 or 13, it was lower in the 50s. But what was coincident was actually both times saw really slow population growth of what you call high income Americans in America. So people in the age 30 to 50. That number has been contracting because the boomers are much bigger than Gen X. And so you actually went from a peak in the 1999 to a negative number in 2008. But because the millennials are now starting to, it's a huge cohort starting to actually generate income, this number is accelerating all the way through 2038. So I think if you overlay demographics and US inflation, they actually map pretty perfectly. And I think it's really a scenario where if the world sort of has anchored in its belief that inflation is actually falling because of aging demographics, it's about to turn in the US. And I think that's one reason why we could be mid-cycle.
So I actually think that the inflation point is a really important one, and I agree with you that people are underpricing inflation. I think the issue with that, though, is because of the pent-up kind of pressure in the credit markets, what that means is that yields are too low. And what happens
You're saying negative real rates.
What I'm saying is just that where we are today is we have negative real rates and expectations are too low, meaning it's worse than just negative real rates. It's mispriced future negative real rates based on central bank actions. I don't think this is driven by market pricing. I think this is driven by quantitative easing and asset purchase programs. So I actually think you're probably right. If you add to that protectionism, which is also inflationary, we've increased protectionism. We likely have a President Warren who's going to win and beat Donald Trump. If President Warren wins, that's also going to put pressure on inflation, probably have more regulation in prices. So I don't disagree with you, but all of those factors mean that the yields will go up. That means bond prices will go down. And so if bond prices go down due to the large amount of debt that has been priced in the way that it has, that in and of itself could cause the credit cycle to enter the next stage. And so I actually think inflation would be quite bad for equities because of the credit cycle implications. I think what probably will happen is I actually think there's one other point that I just want to mention before we leave this topic, which is that the other reason why sovereign credit markets are mispriced is because, in my opinion, they're underpricing political risk.
Mm-hmm.
Sovereign credit markets should be pricing political risk, and they're not. Again, this is because of quantitative easing and asset purchase programs. So between the underpriced inflation, which I agree with, and the underpriced political risk, which I think is not priced in sovereign credit markets, both of those two things, if they were to be properly priced, would cause volatility in sovereign credit, which again would lead into the corporate credit cycle and an overall downturn in equities. Now, on the other side of it, I'm actually very, very bullish because of the demographic points you mentioned. I actually think the US economy isn't that vulnerable in the same way that it was in 2008. Relative to other economies, I actually think we're probably in better shape. So I think what will probably happen is if we get a multiple contraction, to say like 12, 13 times, we get a margin contraction, I don't know, 200, 300 basis points, we could be down 40 or 50% US equities, but then it would be quite bullish because on the other side, we have a pretty stable growing economy. At that point, multiples and margins would be reasonable. And to your point, we have inflation coming. So I think part of our disagreement is really about timing. I'm probably bullish on the other side of what I think would be a healthy correction, clearing of the credit markets, equity markets down. And then on the other side of that, I'd be quite bullish.
I mean, I think inflation is something that's unknown, and so I think it's viewed as a big risk for markets. And it makes sense because let's say someone's managed money for 30 years, okay? So they started managing money in 1990. We've only seen falling inflation and falling interest rates. So, a 30-year experienced money manager has never experienced any other regime except falling interest rates. But we do have a lot of periods in America where there was actually periods of low inflation that gave way to reflationary conditions, either because of tightening labor, trade restrictions, or general demographic trends. And that probably the most analogous period is the mid-50s to the late 60s, where the 10-year went from 1.5 all the way to 8%. Interestingly, the S&P saw a massive acceleration of EPS growth because inflation is accelerating to EPS. It actually also caused the multiple to expand from roughly 15 to 20 times towards 25 to 30 at the peak. So I think one of the things we don't know, and I can't say this is with certainty, I think inflationary development in the US is something we don't know, but I think ultimately it's really positive for corporates and for value. But something I would 100% agree with David, I think that if there is a change in the White House, that to me would be the biggest risk to markets because that is a greater unknown than inflation. So I think that if David's correct and we have President Warren in 2020, I think it would put a lot of risk to someone's sort of long-term bullish view. Uncertainty, I don't think it means it's a bear case. It would create a lot of uncertainty.
Yeah, and you've been very vocal about the political risk, right?
Yeah, and the reason for that is really quite simple. I think that what happens when you do quantitative easing and asset purchase programs is you increase the value of asset prices. And so people who already have assets get richer. And so what's happened is if you look globally, the wealth inequality has never been higher.
Yep.
And populism is just a very natural result to that. So whether you look at Brexit, whether you look at what went on in Greece, Italy, throughout Europe, now even in Germany, and then of course the election of President Trump on a populist message, to me that's a natural response to actually the quantitative easing and asset purchase programs that the central banks have been doing. So political risk is in a way, in my opinion, kind of a market reaction to the distortion that was created. And so to see, President Warren kind of rising and winning is again just a continuation of that populist response, which in market terms means naturally kind of cyclical reduction in margins, probably wealth distribution and other things that might in the short run be detrimental for stock prices, but in the long run actually could be quite good for the US economy, especially if we could kind of get entrepreneurship going again.
Yeah.
We need more startups, and actually startups have been on the
decline.
decline.
But I think that the backwards question I would ask is, let's say Trump is reelected. What do you think that is telling us about where markets are? Do you think that is because markets did fine and we didn't have a recession? Or what sort of equity outcome do you think is surrounding the case where Trump is reelected?
I think that the consensus, I disagree a little bit about what consensus thinks. I believe consensus thinks Trump is going to come up with a magical deal with Xi, therefore stock market will be okay, therefore Trump will win. I think that most people kind of have this idea that he's got some plan and that he and Xi both have an incentive to come up with an agreement that would stabilize kind of this trade dynamic, and then people believe that's enough to keep stocks up. I don't agree with that, but if that were to happen, say stocks were flattish or even up to, you're correct, which there will be. I think that he could get reelected in that environment. I think it'd be very close because ultimately it's going to be about the swing states. It'll be about who's really more populist, President Trump or potential President Warren. I don't know how that'll play out, but I do think that kind of settlement with trade, stocks flat to up, maybe even a little higher, and some kind of story about the U.S. economy recovering would be the way that he would be able to try to defend his
I think that's maybe going to be the bigger swing factor is, what happens in 2020, which is unknown.
Yeah.
It's true.
Yeah.
It's a true story.
Yeah.
It's a true story.
And going back to one point you made about the natural reaction, I think crypto is also a natural reaction to that. I think people
That's right.
see the fundamentals, the problem with the fundamentals, and they're flocking to crypto. What do you think about that?
Yeah, no, I think this is exactly right. So one of the things that I think is important about talking about the markets is that there's this way in which people kind of either flock into kind of like a free market camp or like a market efficiency or efficient markets camp or kind of a pure inefficient markets camp. I think those extremes are probably wrong. And I actually think that we have to pay attention to market signals.
Yeah.
And to me, the market is telling us something with crypto. It was telling us something with the crypto bubble and burst in 2017, but there's still a lot of resilience in the overall kind of landscape. And Bitcoin specifically is telling us a lot. I think Bitcoin is telling us a lot about what people think about fiat money. I think that the idea and kind of the motivation behind a lot of people who are Bitcoiners is about being independent from government and being libertarian. And I think the whole idea of having a decentralized governance system, which is I think what a lot of the non-Bitcoin tokens are about, which is kind of like how can we build an independent way to organize ourselves, independent of the monetary system and government systems. These are all market signals. These are very intelligent people who are involved in your company in this space. Even Thomas, I know, is a really intelligent guy who is bullish on Bitcoin. So a lot of very smart people are kind of pointing in this direction. So I see that as the market saying something.
Yeah.
And then the question is, what is it saying? I think it's saying the old system is failing.
Yeah.
And so again, it kind of like is a data point, and I agree with you that at least to me, the market is saying something's wrong. And I think what's wrong is actually the legacy system.
Yep.
So.
Do you agree with that?
Yeah, I don't think David and I have ever really disagreed on crypto. I think the implication to me is the financial system really let everybody down in 2008. 20% of U.S. households either are short sale or foreclosure. 1 in 5 people. I mean, every millennial knows someone who lost a home, and that's why they don't trust banks. And they're inheriting $7 trillion over the next 5 years. I think they're going to be really important how they allocate assets. But I think in the near term, I do kind of think in the short term, Bitcoin and stocks are positively correlated to each other. So I think one of the more unpopular things that maybe we sort of have in our framework is that S&P making new highs is central to Bitcoin breaking out. And I think if the S&P has a downturn, I think in the short term, it's going to actually create some headwinds for Bitcoin.
It's possible. I mean, so it depends on how violent it is. I think that in a violent unwind scenario, like if we have like a European banking system fail or Japanese banking system fail or some kind of war-like event, I think these are possible tail scenarios that might happen. In those type of scenarios, I think there could be a liquidity crunch, and then in the short run, it could cause all assets, including Bitcoin, to kind of be under pressure. However, if it kind of happens in a more gradual way and there's an allocation shift, let's say it's kind of a rotation to value like we were seeing recently. If we can anticipate some of these shifts, I do think that there's this kind of deeper trend of the institutional money that is coming into Bitcoin. And if Bitcoin can remain resilient, we're at a pretty critical level here around 10,000. We'll see if it can hang in, and some questions we'll see the answer to here shortly. But let's say it's resilient in this level, and we have kind of a gradual unwind. I think in that environment, the institutional money might actually start to say, hey, look, especially if gold is doing well, maybe we should have our 1 to 2% allocation to Bitcoin, and it's just such a tiny market cap that might be enough to offset the natural forces, which I agree with you. If it's violent, it's going to be hard for anything really, besides being short, which is probably the right thing to do. But short everything, sorry, be bearish, short it all. It's just,
And ironically, everybody buys treasuries, right?
Yeah.
Exactly.
Okay, so you think we're in mid-cycle and you think we're later in the cycle. So what's your time frame for where you think the next recession is? I'll start with you.
So, I think there's an important distinction between recession and markets, and especially when it comes to the US and the markets, meaning that I think that a lot of people, and historically it's always been the case, that if the US is not in a recession, markets can't go down. That's different now. We're in an earnings recession already in the S&P 500 in Q3 of 2019. And the reason is that outside the United States, China, Germany, South Korea, many other countries are already in kind of slowdown mode. So I think what matters more is markets. I think markets are going to be down. I think they began declining actually in 2018, and what we've seen since then is kind of a bounce, and the central banks trying to stabilize things. I don't think they've done a very good job. They've done all they can, but I don't think they're going to be able to stave it off. And so I think the markets have just kind of begun an unwind. They began in 2018. There's a lot more to go. Now the U.S. recession, I don't know. I think that the U.S. is actually in a relatively decent economic position. Like even if we have a recession, I don't know how deep it necessarily will be. But I don't think that necessarily matters for markets because earnings, we could have margins down and we can have kind of, global economy slowing down in the US in just a mild recession. It's actually be down 40 or 50% just based on multiple compression in margins. So that's my own, kind of way of thinking about that.
Yeah, I mean, I think what's important to keep in mind is if you look at the composition of S&P earnings today, 18% of the index is deep cyclical, which is industrials, energy and basic materials, and about 66% of the S&P is essentially consumer staples and what you call cyclical, less non-cyclically sensitive sectors. And I think that's the reason why when you look at earnings recessions, and I think a lot of people have been bearish on that sort of bet that earnings revisions being negative is negative for stocks. In the last 30 years, only 3 of the years had the S&P price outcome because follow the earnings revisions. 27 of the years follows what the PE does, and and unless we have an outright recession, it's really going to be about the PE, and PE has been expanding this year. I think markets have been looking through the earnings recession. I think one of the reasons being, look, the PMI is a leading indicator for earnings growth, and that's tanked. And I think people are saying, well, the market should be tanking out because the PMIs are under 50. We told our clients at the start of this year that by the fall the PMIs would likely be below 50. So we were bullish at the start of this year, but we had something that I think is a very reliable leading indicator tell us the PMIs would tank, which is the long-term yield curve. And that same long-term yield curve is telling us we're going to start to see a real PMI recovery, maybe beginning in the fall, but really strongly into next year. And I think it makes sense. That's the inventory destocking being done. Oil's recovered. Trade war. This is really conditional, not escalating. But I think in the current conditions, we could still have a big PMI recovery, even with tariffs at these levels. So if that's the case, I think markets are starting to price in a cyclical recovery next year.
Fascinating. Okay, so guys obviously agree on a lot, but you still disagree on a lot. So I would love for you to close off with a minute each. You have questions?
Yeah, we have one question actually from one of our community members, Tanya.
Sure. Yeah.
If you don't mind her coming in. She's, by the way, our expert on these issues.
Oh, perfect.
By far the most agrees received on this particular macro topic.
Cool. What's your question?
The question that I have is
Here, Tanya, can you just scoot right next to Preeti? Perfect. Thank you.
So the question that I have for both of you is, in the next year, whether the recession is coming or not, how do you think the millennials who don't have assets, how are they going to be affected?
Yeah, I think that's a really important question. I actually think that is one of the main reasons why I think President Warren's going to win the election. Meaning that I think that a lot of the kind of institutional, like legacy political apparatus, of both political parties, focus a lot on the wealthy. And they focus a lot on big business, and they focus a lot on people who have assets. And to your point, a lot of people don't. Actually, a lot of American households, especially young people, don't. And so I actually think that there's a little bit of a kind of a disconnect between what's resonating with people. Young people love Bernie Sanders. Young people really are interested in some of these social issues. And so I actually think that the younger people get it, that the system has really been working for a corporate elite and for the wealthy. And so that kind of energy, which is behind the Sanders campaign and the Warren campaign, I actually think could help to propel her, further in the polls. If that happens, to Thomas's point, I actually think it starts to feed into some of this market stuff. Again, I don't necessarily think that we have to have a recession for the markets to go down 40 or 50%. That's one thing that maybe we disagree about a little bit. I don't know if we firmly disagree about that. I think that I actually agree that multiples are the key thing. So I think that we could have investor nervousness, credit market volatility, multiples contract, margins down because of some ex-US stuff, causing the markets to be in 40 or 50%. But then the people energized by a President Warren campaign, they could kind of be seeing the future of a different kind of economy that works more for the people. And they could be okay. They could say, look, the recession isn't that bad. Jobs, there may be some jobs lost, but it wouldn't necessarily be as bad as 2008. So that the people who are kind of, being served by the promise of this new administration might actually be pretty happy because they're like, look, yeah, people on Wall Street are pretty sad, the markets are down, and I know that a lot of people are losing money in the markets, but we really care about the future. We care about the future of jobs, small business, and some of the other things that administration is focused on. So I think that it's possible that could be okay if it plays out in the way that I'm laying out, which I don't know if it will or won't, but if it did, maybe that would be okay.
Now that's an if, because I'm not agreeing that a recession starting next year. But if a recession started next year, this would be the first recession for a millennial working, because the average millennial today is 26 and a half. In the last recession, they were 16, so unless they were Doogie Howser, they weren't working. But here's what's interesting. The last recession was the worst recession since the Great Depression. So it was essentially a depression, and it lasted 18 months. So it's a year and a half that you have to think about. If you look at the 26, the unemployment rate of the 26 to 30-year-olds, which is really where the millennials are today, that number was 25% during the expansion, the unemployment rate, and it hit 30% during the recession. So out of 100 friends, only 5 more people lost their jobs. It's not like every millennial is going to lose their job. It means 1 in 20 is unlucky and gets unemployed during the worst financial crisis since the Great Depression. So I don't know what the next recession looks like. In fact, no one can predict. No one can predict. Anyone who says the next recession is mild has no idea what they're talking about. A recession is unpredictable, and the next one could be a depression. I mean, I don't know. I don't think it's happening next year. But if it does, I think the majority are going to be depressed, but everyone's going to still have a job. The majority still have a job.
I agree. We agree.
Awesome.
Yeah.
Thanks for the question. Awesome question.
Yeah.
Okay, so again,
So David and I are going to go in the back alley now.
just 1 minute closing. So imagine if the watchers, viewers, they were only watching this 1 minute of the debate. What would you say are your key points that you're making for why you don't believe there'll be markets are braced for a downturn, and why you do believe markets are braced for a downturn? And we'll start with Thomas this time.
I don't know if markets are braced for if a downturn's going to happen, but the nature of our research is really to know what the market's pricing in. And when you look at Google searches, for instance, on inverted yield curve or recession, there's 4 times as many searches today for inverted yield curve than there was in December 2005, population adjusted. And the search for recessions already matches the peak in January 2008, in the height of that recession. So the world is already freaking out about a crisis that may or may not be taking place.
So to me, it's really quite simple. I think that central banks mispriced government debt for 10 years. We now have negative yields across most of the world, including $1 trillion of negative yielding corporate debt. We've learned it throughout history that if you have a big credit bubble and you have debt that's mispriced, that comes back to haunt you. And I think that right now we're kind of at the end of what is now the biggest credit bubble in history, far bigger than 2008. Because of that, it seems quite natural that as this credit bubble unfolds, we'll have credit market volatility and equity markets will go down. Equity markets tend to go down from time to time. I'm also very, very optimistic about the long run. I think true story, I think people who are building the future are actually driving things in a new direction, which means that some of our legacy structures are going to have to fail. So I actually think a collapse in equity markets, I think that a collapse in the old system, maybe even a new government wouldn't be the worst thing in the world. In fact, maybe markets would be down 50%, but then we can build a better tomorrow. So I'm actually very, very optimistic. That actually makes me think that maybe the markets will go down a little bit more than people think, so we can tear down the old system and build something new. So I'm an optimist, but as Paranoid Bull would say, cycles matter.
Awesome. Well, thank you so much for both of you for being on here. We'll publish this video soon. We should check back in how long? 6 months? 3 months?
6. Yeah.
6
3,
months?
6, you pick.
We should just set it to the calendar, right?
And put $100 on the line, and let's see. Ready? Awesome. Cool. Thank you.
Okay.
Thanks. Bye.
Awesome. Thanks so much for watching. I really hope you enjoyed the debate and that you found it insightful. Our goal with these debates is to bring experts from both sides of any issue so we can critically think about the issue, understand both sides, and make progress. To that end, if there's anything that we can do to make these debates better for you, please let us know in the chat below. Until then, I hope you'll join us on beta.truestory.io. Stop yelling, start debating, only on True Story.